Welcome back, students who are taking financial accounting. In this series of videos, we are working on the assigned homework problems from the digital study guide for Chapter 7. The exercise is for Group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Okay, so let's see here. We finished up on exercise 7-32 in the previous video, so we're working on 7-33. And it says here, Fessler Industries used the direct write-off method to account for bad debt. Record the following transactions that occurred during the year. So on May 3rd, they provided services of $1,300 of services to Beth Wilson on account. Okay, so remember, when we're making journal entries, all right, go back to the theory videos if you on how to make journal entries if you don't know how. There's a couple of videos there that explain my thought process for making journal entries. So the first question I ask myself is, am I affecting cash? And in this case here, no, I'm not, right? So I ask myself the second question, am I affecting accounts receivable or accounts payable? And in this case here, we're providing services. So, we're the vendor and the customers, we're providing services to a customer for $1,300 and it's on account. So the answer to my second question here is, are we affecting accounts receivable or accounts payable? And yes, because we're affecting accounts receivable because it's on account. So if our accounts receivable was 0 and now we're providing $1,300 in services, that means the accounts receivable goes up. Accounts receivable is an asset, just like cash is an asset. And we increase our assets on the debit side, so I'll debit accounts receivable for $1,300. And I'll credit, what are we doing? We're providing services, all right? Well, debits have to equal credits, so we look at our categories of accounts. Since we're providing services, that's not an asset. It's certainly not a liability. It's certainly not equity, so our only other two choices are revenues and expenses. Well, obviously this is a revenue, so we'd look under our revenue accounts and we'd choose some type, whatever account fits the bill for revenues. So we'll just call this service revenue for $1,300, and that's that journal entry. Okay. November 8th, wrote off Beth Wilson's $1,300 on account as collectible. So we're using the direct write-off method, and when we're writing it off, the reason why it's the direct write-off method is because we're directly writing off the accounts receivable, right? Since it's not collectible, we're writing it off to bad debt. So if we debited the accounts receivable and now we're going to write it off, we want to get it off of our book, so we make the opposite side of the entry. So that's we're going to credit the accounts receivable for $1,300. If I have a debit here for $1,300, right, and I have a credit here for $1,300, that washes itself out. $1,300 less $1,300. And since I credit accounts receivable, I have to debit something else. Well, what are we doing? We're writing it off, so we write it off to bad debt expense for $1,300. Okay, so on 12/10, unexpectedly collected $1,150 from Beth Wilson on the account that had been written off. Fessler Industries does not expect to collect the remaining balance. Okay, so when that happens, okay, What we have to do is, let me just erase this a little bit here. What we need to do is we need to first reverse this entry. Okay. So we just make an entry because this way it puts it back on our books, puts it back onto our accounts receivable. So we're going to make a reversing entry of that. So if I had a credit to accounts receivable, now I'm debiting accounts receivable for $1,150, and I'm going to credit my bad debt expense for $1,150. Okay, so that just reversed the entry, right? Now we have to record the payment of it, right? So I'm just going to write it in real small here. So on 12/10, we received cash for $1,150, so we're going to debit our cash for the $1,150, and we have to credit something else. Well, he's paying off the accounts receivable, so I credit my accounts receivable for $1,150, and so this debit and this credit for $1,150 wash each other out, and the accounts receivable is zero, and we've received the cash here, and out of the service revenue, right, out of the $1,150 we received cash for, and the difference between the two is that $150. Difference between the two is that debit to bad debt expense that we're not expecting to collect. Okay, so everything hits the books the way it's supposed to. Right. All right. Now I'm going to move on to 34. It says here, Tech Automotive ended December 2013 with accounts receivable of $30,000 and a credit balance and allowance for uncollectible accounts of $4,000. During January 2014, Tech completed the following transactions. Right, requirements: prepare journal entries to record sales. Ignore cost of goods sold. Remember, whenever you record a sale out of that you make a sale out of inventory, you have to make, you're going to make a corresponding entry to take it out of inventory, take that item out of inventory and put it to cost of goods sold, but it's telling you to ignore the cost of goods sold. Okay, so prepare journal entries to record sales, collections, write-off of uncollectibles, and bad debt expense by the percent of sales method. So basically what we're doing is we're looking at an accounting period and treating we're looking at the entire accounts receivable for the entire month to include using the percent of sales method to record the estimate of uncollectible accounts. The number 2, calculate the ending balance in accounts receivable, allowance for doubtful accounts, and net accounts receivable for January 31st. How much does Tech Automotive expect to collect? Right, so let's draw a T account up here. Call this accounts receivable, and I'll draw a T account over here, and I'm just going to write allowance, but this is my allowance for doubtful account, uncollectible account. Right, so it ended December 13th with an accounts receivable of $30,000. So my beginning balance is $30,000 on January 1st, right? And a credit balance in the allowance for uncollectible account of $4,000, right? That's my beginning balances. Now they completed these transactions. All right, so sales of $158,000, which included $98,000 in credit sales and $60,000 of cash sales. Ignore cost of goods sold. So my journal entry, all right, so when I'm looking at that, am I affecting cash? Yes. I'm collecting $60,000 in cash. So I'm going to debit my cash for $60,000. Right. In this case here, I am, I have sales of $158,000. All right. So I am going, I'm sorry, which include $98,000 in credit sales. So I'm going to debit my accounts receivable for the $98,000. Right? Because remember, I ask myself, am I affecting cash? Yes. Then I ask myself, am I affecting accounts receivable or accounts payable? Yes. And then I back into debits must equal credits. So I back into, and what am I doing? I'm making sales. So I have sales revenue for the $158,000, and that's my journal entry to record A. Okay, B, it says cash collections on account for $77,000. So am I affecting cash? Yes. I'm debiting cash for $77,000, and what am I collecting it? I'm collecting on account, so I'm going to credit my accounts receivable for $77,000. Right. C, write off uncollectible receivables of $900. Okay. Now, here's the catch. We already know that we have a balance here of $4,000 in our allowance account from December 2013. All right. So we've already calculated the estimate of uncollectible accounts, and that's all part of this $4,000. So now when we look at our accounts receivable, all right, and we say, okay, we know definitely $900 is not going to be collected. Well, we have to take that $900 off of our accounts receivable, right? So we end up crediting our accounts receivable for the $900 because we're taking it off. We're reducing our accounts receivable, and then we have to debit something else. Well, we're going to debit our allowance account for the $900. Okay, and so that removes the $900 out of this $30,000 on our accounts receivable that we know is not going to be collected. Okay, so then D, bad debt expense is an estimate of 1% of credit sales. Okay, so what were our credit? Okay, so now it's the end of the month, and we're closing out the month, and what we're doing is we're making sure that our accounts receivable is relatively correct by using the percent of sales method. Oops. Okay, so we're going to estimate 1% of credit sales. Well, what were our credit sales? Our credit sales were $98,000. Right? So if I take $98,000 and I multiply that by 1%, that gives me $980. Right? So as part of the percent of sales method, we debit our bad debt expense for $980, and we credit our allowance for uncollectible account for $980. I'm not writing it all out there. I'm not writing out the entire allowance for uncollectible account. You know it's allowance. So I'm crediting the $980 there. Right? So now these are all of our journal entries, and it's that was the preparation of the journal entries. Now it says calculate the ending balances in accounts receivable, allowance for uncollectible accounts, and what is our net accounts receivable. So basically, we're going to post these journal entries to our general ledger accounts. So I'm going to do that in blue. All right. So I have my accounts receivable here for $98,000 as a debit. I don't need the sales revenue, don't need the cash. I have a credit for $77,000 to accounts receivable. I have a debit of $900 to allowance for doubtful account. I have a credit for 180, oops, not 900, 980. Wait a minute, I'm sorry. 900 is 900. Boy, Jim, 900 to our accounts receivable. I don't need bad debt, and then I have a credit of 980 for the allowance account. So now I need the balance, and when I 30,000 and 98,000 is 128,000 less 77,000 gives me 51,000 less 900 gives me a debit balance of 50,100. And for my allowance account, I have 4,800. I'm sorry. 4,080 as my balance in my allowance account. Okay, so if I have now, so that's the ending balance of my accounts receivable, the ending balance of my allowance, and now my net receivable is the 50,100 less the 4,080, which is 2064. Is my net receivable is $46,020. It's the difference between both of those. Remember, when you're looking at your balance sheet, okay, on your balance sheet, you'll have cash, then you'll have your accounts receivable, then you have your less your allowance for doubtful account. So you had 50,100 here, and then less your allowance of 4,080 here, and then your net accounts receivable would be this here $46,020. Okay, so that's it for this exercise. And again, if you don't understand something, you'll go back and watch the theory videos, and if you still don't understand something, feel free to contact an instructor. And see you in the next video.